The analysis report, "Do not panic. Stop the truth about the SOX drop." It's a high-energy piece focused on turning that recent, pretty scary minus 11% ETF drop into a very defined trading opportunity.
Right, and it's all built around technical support levels.
Exactly. So a big theme here is establishing authority, trying to calm nerves and immediately pivot people into opportunity mode.
And it does a good job asserting that this volatility is just the price of admission.
It does. It frames the drop as a leverage flush, weeding out weak hands, not a fundamental breakdown. The technicals are sharp too. Identifies the rejection at $41, the floor around $35.50, $36.
And the action plan is super aggressive. Watch the open. Buy if it holds $35.50, target 38. It's clear.
Very clear. But I think the delivery needs some work to really maximize that authority. Let's start with the overall pacing and tone, because I think the initial use of those heightened visual and audio cues might actually conflict with the core message, which is calmness and preparation.
I got caught there too, right at the beginning. The intensity is huge. You've got the flashing red screen, the siren sound effect for that $4.50 drop. It definitely grabs you.
Oh, it grabs you.
But the weakness is that you're creating this real sense of panic, and then you immediately pivot to a very calm, very analytical, do not panic.
It's emotional whiplash.
Total whiplash. You've just spiked everyone's cortisol right before you ask them to sit down and absorb complex data. It feels like a jarring sequence, and it sort of undermines the whole steady hand you're trying to project.
That's the exact tension. That's what we need to solve. So the suggestion here is to adjust the pacing and the intensity of that opening delivery. It needs to align better with the authoritative, analytical tone required to deliver the truth.
The mood needs to be supportive and analytical from second one.
Right. To establish control.
Okay, but hang on. I wonder if toning that down completely risks losing the audience in the first 5 seconds. I mean, financial news is sensational. If the goal is high-impact engagement, how do we grab them if we don't acknowledge the pain of that drop?
That's a fair pushback. I agree.
We shouldn't remove the energy. We just need to redirect it somewhere more productive.
I think that's the key. We don't eliminate the gravity of the move. We just anchor it in data immediately. So for a concrete example, instead of leading with just a siren and a huge flashing minus 11% graphic,
Yeah.
what if you start by immediately showing the 6-month chart view? This visually anchors that volatility as just a minor correction against what the analysis itself says is a broader uptrend.
I like that. I like that a lot. It turns the shock into context right away.
Instantly.
Or, okay, another idea. If you absolutely must lead with the pain, use a graphic that features both the rejection level at $41 and that floor at $35.70 simultaneously.
Oh, that's good.
Because that single graphic frames the move not as a disaster, but as a contained event. It's happening within known technical boundaries.
Right. So the focus shifts instantly from just generalized panic to technical precision. It makes the rest of the analysis feel earned and trustworthy. The first impression becomes one of control, not crisis.
Exactly.
Okay, let's pivot to the central argument, the segment called The Truth, demystifying the drop. Now, the analysis correctly identifies the drop as a technical leverage flush, but I think integrating more specific mechanistic data would seriously bolster its credibility, especially for a knowledgeable base.
This is where we move from just asserting something to actually proving it.
Yes.
The analysis is effective at dismissing bad news, but it relies on this blanket term leverage flush and the rejection at 41. The weakness is that it doesn't explicitly detail why. Why did the underlying index movement trigger this specific, $4.50 correction?
It just states it as a fact.
Right. It says a minus 10% move is normal for a 3x ETF, but it doesn't really integrate that into the narrative. It feels like a footnote, not the engine driving the whole analysis.
The smart consumer isn't just asking if it was normal. They're asking how we know it was normal. So the suggestion is to strengthen that explanation. Directly link the move in the leveraged ETF to the necessary percentage move in the underlying index.
We need to show them the math of the flush.
Exactly. Clarify that mechanical chain reaction of the technical cooldown.
And does the analysis really establish that connection fully between the underlying index and the ETS performance? Or is that an area to, really build out?
It needs to be built out. Absolutely. When discussing the 11% drop, you have to explicitly state that this movement means an approximate, minus 3.3% correction must have happened in the underlying index?
In the component stocks.
Yes. That minus 3.3% figure is the key.
And now we can use that figure to explain the market action. That 3.3% move, combined with the 3x structure, forces specific institutional behavior.
Right, like automated daily rebalancing, delta hedging.
And forced profit-taking from short-term traders on tight margins. The analysis has to explain that the drop wasn't just random selling, it was the mandatory mechanical consequence of hitting that threshold.
That's the word mandatory. This transitions the analysis from just stating a fact, volatility is normal, to actually demonstrating the complex mechanics. It proves the claim that this was normal for this instrument is mathematically and mechanically sound.
It's the difference between a good analysis and an authoritative one. We're showing them the gears turning inside the clock.
And this is critical, because if you fail to prove the drop was technical, not fundamental, your entire opportunity thesis it collapses.
The depth of that proof is what validates the immediate buying strategy.
Okay, so let's transition to execution. Let's look at the game plan section. The immediate strategy is sharp, but I think the whole plan is so time-sensitive it needs a more robust framework. One that keeps that opportunity mode narrative going even if the immediate support levels fail.
Yeah, that's a huge vulnerability. The current plan is so laser-focused on an immediate snapback rally to $38. It's completely reliant on that 35.50 trigger holding right at the open.
It's a single point of failure.
It is. And the weakness is that the next logical support level, $33, is treated purely as a failure point, a stop loss. It's presented as, if we break 35, then we talk about 33.
It makes the whole strategy feel incredibly fragile. If that first trigger fails, the analysis basically tells the reader to stop out and panic.
Which directly contradicts the entire do not panic thesis.
You have to maintain the bullish, opportunity-focused narrative, no matter what the short-term price does. So the suggestion is to build out the contingency planning, offer explicit guidance for a deeper correction.
So the analysis provides an actionable strategy across multiple volatility scenarios.
And that supports the overall bullish sentiment that the trend is your friend. The analysis should be a blueprint for finding value even if the market decides to take the deep discount option.
And isn't there a risk that focusing only on the immediate bounce makes long-term holders feel abandoned? If the swing trade fails, the person who's really committed still needs a narrative.
Of course.
We have to integrate $33 into the opportunity structure. Right now, it's viewed through a lens of pain, when, for a serious investor, a deeper correction is just a better entry point.
That's precisely the shift in tone we need. For a concrete example, you could add a secondary, highly structured component to the game plan that treats a break of 35 not as a disaster,
but as a deeper accumulation opportunity.
Yes. For instance, the analysis could explicitly say something like, if the first trigger, the swing trade, fails, the deep support at $33 must be viewed through the lens of long-term opportunity.
And then you connect it to the chart. If 33 holds, this level aligns precisely with, X. Previous structural point on the 6-month chart, presenting a superior high-conviction entry point for investors with a longer time horizon.
That distinction is key. It clearly separates the short-term tactical trade from the long-term value thesis. It gives the listener an answer for every scenario.
So the idea of opportunity is there, whether the bounce is immediate or comes after a deeper capitulation.
And it completely removes the potential for panic if that $35 support gives way because you've already given them the next target for maximum value.
And strategically, this makes the analysis report relevant to a much wider group, from the aggressive swing trader to the committed long-term growth investor. That robust framework just enhances the authority exponentially.
All right,